Rivian Automotive Inc. is trading live right now at $13.34, down 3.60% in today's intraday session. While most investors are watching this midday slide and hyper-focusing on the headline production struggles, a much larger mechanical story is developing behind the scenes. Volkswagen just completed a massive $1 billion private placement purchase of over 62 million shares of Rivian stock at $15.90 per share. This means institutional capital literally just paid a premium above today's market price to secure a piece of this enterprise, creating a massive valuation arbitrage between public market panic and private corporate evaluation. The standard market narrative surrounds the crushing weight of high interest rates on capital-intensive sectors, leading many self-investing individuals to treat this as an avoided asset class. People look at the broader electric vehicle market, see the price wars matching legacy players against a volatile backdrop, and assume the entire space is structurally broken. When you check regular investing sites or open your default individual brokerage page, the common consensus positions this company as a cash-burning machine trapped in a permanent valley between its high-end first-generation trucks and the promised mass-market vehicles of the future. The prevailing wisdom tells you to stay away until macro conditions clear up and profit margins turn positive. The reality of the situation challenges this narrative completely. Look closely at the recent first-quarter earnings numbers that just dropped earlier this month. The headline figures actually beat expectations, showing a narrower adjusted loss per share of 33 cents against the 63 cents the street projected, alongside revenues hitting $1.38 billion. The hidden tension, however, lies in where that revenue is coming from. Roughly half of that automotive revenue is tied directly to a single commercial fleet contract with Amazon. This structural dependence creates an incredible push and pull inside institutional order books. Large funds using sophisticated platforms like interactive brokers' trading suites are actively recalculating their risk weightings, balanced between the safety of a guaranteed corporate buyer and the extreme concentration risk that comes with it. We are seeing a noticeable divergence in how different tiers of retail and institutional participants approach this volume. On retail-centric platforms through the Robinhood app or a basic Fidelity mobile app, we are seeing a steady accumulation of fractional shares, driven by a belief that the bottom is firmly in place around these $12 to $13 levels. Meanwhile, heavy-duty institutional desks utilizing specialized interactive brokers' platform accounts are leaning heavily into complex derivatives to hedge their exposure, preparing for a highly volatile summer. The trading volume over the last several sessions has consistently hovered around 40 million shares daily, which is significantly elevated above its historical baseline, revealing that shares are changing hands rapidly between short-term speculators and long-term accumulation accounts. If you look across the digital wealth management landscape, from automated options like Schwab Intelligent Portfolios to managed Fidelity wealth management accounts, allocations to emerging automotive names are being reassessed. Traditional Fidelity mutual funds and broad market basket vehicles are forced to hold baseline percentages due to index tracking, but the active management side is playing a defensive game. For anyone involved in self-investing or actively seeking tailored investment help to optimize an individual brokerage setup, understand when this friction between retail optimism and institutional hedging is critical to navigating the space. Comment below how many shares of Rivian stock you currently hold in your portfolio today. To understand why this daily price action is so fiercely contested, we have to examine the underlying mechanics of the business model itself. This enterprise operates as a vertically integrated premium electric vehicle manufacturer, focusing heavily on consumer sports utility vehicles, luxury adventure pickup trucks, and commercial delivery fleets. Unlike legacy players that anchor their supply chains to outsourced components, this firm designs its core compute architecture, network topology, and vehicle control software in-house. This strategy is precisely what attracted the massive $1 billion capital injection from legacy international automotive groups, who are essentially paying a premium to acquire software architectures they failed to build internally. This brings us to the core operational conflict that defines the company's financial health. Historically, manufacturing these complex platforms has been an incredibly expensive endeavor, resulting in negative gross margins that have dragged down performance for consecutive quarters. Management has spent the past year re-engineering their core production facilities, executing multi-week plant shutdowns to clear out component inefficiencies, introduce simplified wiring harnesses, and integrate new thermal management systems. The strategic goal here is to achieve positive gross margins by the end of the year, a milestone that would fundamentally shift how the asset is valued across online investing networks. When you look back at older financial reports from late last year, the cash burn was the single most terrifying metric on the balance sheet, frequently overshadowing operational progress. The company was burning through billions as it attempted to scale its manufacturing footprint, causing immense anxiety across major banking institutions and retail brokerages alike. This historical weight is why the current stabilization in operational cash flow is catching some analysts off guard. First quarter operational cash outflow narrowed significantly to $188 million, down from well over $1 billion in the prior year's matching period, showing a clear structural path toward operational stabilization. Looking forward, the absolute linchpin for this stock's terminal value rests entirely on the execution of its upcoming mid-tier platform, scheduled to begin manufacturing and deliveries within the next 24 months. This upcoming vehicle family represents a massive shift down market, moving from a luxury $80,000 average selling price down to a mass market $45,000 target. This pivot alters the entire investment thesis, transforming the company from a niche luxury builder into a high-volume manufacturing competitor capable of fighting for global market share. However, building an entirely new production line while simultaneously managing current capital expenditures presents an extraordinary execution risk that will test management to its absolute limits.
The macroeconomic environment introduces a final critical layer of pressure that cannot be ignored. Persistent high interest rates act as a double-edged sword, making consumer auto loans far more expensive while simultaneously increasing the cost of capital for corporate expansion. If the broader economy slows down faster than anticipated, premium consumer discretionary purchases will be the first line item cut from household budgets, directly impacting fulfillment rates for existing reservation queues. Conversely, if we see a macro easing cycle begin later this year, capital-intensive growth stocks sitting on freshly stabilized balance sheets could see an incredibly violent upward re-rating as risk on liquidity pours back into the sector. In summary, the deep disconnect between public market sentiment and fundamental corporate development defines the trading reality for this asset today. While the live intraday drop to $13.34 reflects immediate retail anxiety and broader sector weakness, the underlying financial structure is showing distinct signs of stabilization, validated by massive corporate capital buying in at a clear premium. The baseline expectation of a terminal cash burn is being fundamentally challenged by structural margin improvements, narrowing operational losses, and a fortified balance sheet backed by global commercial partnerships. Navigating this environment requires looking past the daily noise of retail trading platforms and tracking the real structural milestones of industrial scaling and institutional accumulation. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.